You have been involved in the crypto space for more than a decade now, and you have seen it evolve through the years. So I'm curious to get your take on crypto markets, specifically Bitcoin, which has been trading in a tight range for months. It has not been able to surpass the $32,000 level so far this year. And the cryptocurrency is trading more than 50% lower than its all-time high reached back in 2021. How do you explain that, and what do you think is driving crypto prices right now?
Yeah, I'm glad you talked about it in a range, because I do think that's the best way to think about Bitcoin's price. It tends to trade in a range when there aren't new market participants coming in or leaving. And it's the same set of market participants sitting in there and participating. And what we've found is that right now, for the past 6 months, 12 months, there has not been a lot of new retail participants or new institutional participants. Now, it's interesting because it doesn't feel like the depths of a bear market, because there are people building amazing products. It's a time for people to get together and create new things, but there aren't new participants coming in that we're really seeing. And as a result of that, people are sitting there with the Bitcoin that they own, and it's not trading out of that range. And what we tend to find is that when you see the bull runs and the price goes up, that's a result of new participants coming in, whether that's a retail wave or an institutional wave. When it goes down, it's people exiting. But right now, we're just in this time where people are building, and as a result of that, there aren't a whole lot of new people coming in or leaving.
Speaking of bull runs, I just did a report on Bitcoin's next bull run, what could spark that next bull run, and industry insiders I spoke with pointed to three catalysts. One, those applications for spot Bitcoin ETFs. Two, regulatory clarity. And three, a key technical event called the Bitcoin halving. What do you think could catapult Bitcoin into its next prolonged rally?
I would agree with that set of characteristics. Typically, the halving, which happens once every 4 years in the Bitcoin protocol. And that's an event where every 4 years, the number of Bitcoin mined gets cut in half. And the reason that's really important is because if there's a set amount of demand in dollars for Bitcoin, but the number of new Bitcoin getting created gets cut in half, well, that means that same level of demand, but decreasing incoming supply, and that can often be a catalyst for a market movement. And so that's, I think, one really big thing. Certainly the Bitcoin ETF, there's been a lot happening in the courts and otherwise about this, and it feels like it's on the precipice in a lot of ways. Those feel to me like the two big catalysts for this to happen.
What do you think will happen with those applications for spot Bitcoin ETFs? We have seen many applications from big names in finance, including BlackRock, the world's largest asset manager. Do you think those applications will actually get approved? And if so, what does it mean for the industry?
I think it has to happen at some level. And it feels like BlackRock and others getting in, they're not going to take a run at this if they're not confident that they're going to be able to get it through. Not necessarily on the very first try or anything like that, but it's unlikely to me that they're going to put themselves out there and say, we're running this, if they don't know, or at least really believe that they're going to be able to make it happen. So it feels like it must happen at some point soon. And I've found the dissents from SEC commissioners to the opinions that the majority is saying, we're not going to do these ETFs. There are then dissents from the other commissioners. I found them very compelling on their merits. So it feels like this has to happen. In a lot of ways, though, this is a catalyst for more people to come in, like I was talking about before, both more institutional and more retail participants who aren't ready to own Bitcoin in a self-custody form where they actually own the asset, but they'd rather trade it in their brokerage account. And the ETF allows them to do that in a much easier way. So I think it's really good. It's promising for adoption. At the same time, to me, the ETFs don't cut at what crypto is really all about, which is about owning your own assets. It's about owning your own keys. It's about being in control of your money. Now, would I rather someone have the option to buy a Bitcoin ETF as a first step into the space? Yes, of course, that's amazing. But ultimately, I hope that everyone can take a step even beyond that and truly own the underlying assets themselves.
Let's talk payments. Your crypto wallet Beam, which has the backing of A16Z and the investment arm of Coinbase, went live in July. You call it a non-custodial payment service, kind of like an on-chain Venmo. Can you explain what you mean by that, and how does it work exactly? And you know, there are a lot of crypto wallets out there, so how does yours separate from the competition?
Yeah, great question. So first, I think there's a really important distinction to draw between custodial products and non-custodial, or sometimes called self-custodial products. These are two very different things in the crypto space. The products are either custodial or non or self-custodial, which are synonyms. And what that means is that with a custodial product, there is an entity somewhere that is actually holding your assets. So if you own one Bitcoin or one USDC or whatever it is, someone else is holding it for you. A great example of this is Coinbase. So when you have assets in Coinbase, they are holding onto it for you. You do not actually have access to those assets on the blockchain. You have access to Coinbase's service, and if you want your assets, they can give them to you. This is very similar to a bank, or really most any traditional financial product, where someone is holding your assets for you. Then there's these non-custodial or self-custodial products. And these are products where you actually have direct ownership of your asset on the blockchain. What that means is that these assets exist on this blockchain, which is a piece of technology, and by having a key to a certain account, you have access to that. You're not relying on anyone else other than the blockchain functioning to own your money. You have it. And so these are two very different things. Coinbase is kind of the canonical example of a custodial product in crypto, and MetaMask or Ledger are two of the very popular non-custodial products. So a ledger, some of you may have seen it on the show Billions, is this physical device that holds your crypto assets. And that physical device, no one else can access your funds other than you. Ledger, the company, cannot access those funds. It's just you that can access it with that device. And that's what's called a non-custodial product. So Beam is a non-custodial product. It is a product that you can use to access your own funds on the blockchain. We don't have any control over your assets. Even if we wanted to take your assets away from you, we couldn't, because you are in full control of it through this interface. And I think the biggest way that Beam differs from other wallets in the crypto space is that it's very narrow. Beam is for payments. It's meant to be used as, like you said, an on-chain Venmo, a peer-to-peer product where you can pay someone else, you can pay merchants, but it's not meant to do everything. And most wallets in crypto, again, MetaMask, Ledger, any of these wallets, they can do everything. They can trade, they can send money to people, they can interact with decentralized products, they can hold NFTs, they can do all of these different things. And Beam is much narrower. It has guardrails. All you can use it for is payments. And the way I would think about it is that these generalized wallets like Ledger or MetaMask, they're like web browsers. They can do anything you want to do, right? When you go on the web, you can access any website, you can do anything. You can send a message on Twitter or X, you can go on the NewYorkTimes.com or CNBC or whatever you want to do. And Beam is much narrower than that. So Beam is like a single application or a website on the web rather than being a web browser itself.
Expanding on that, why do you think the non-custodial nature of Beam, of your crypto wallet, appeals to customers, especially following the collapse of FTX?
Yeah, I think there's a lot of reasons. FTX is a perfect thing to point to. People think that, or say that FTX was a failure of crypto. But really, I think it's a failure of centralized institutions. Sure, FTX was a business that traded in and had an exchange for crypto assets, but what failed wasn't the blockchains and these decentralized products. What failed was actually this opaque centralized entity called FTX in Alameda that effectively walked away with customer funds. And the reality is that couldn't happen with a product like Beam or MetaMask or Ledger or any of these non-custodial products because they don't have access to your money. And I think this has always been the promise of crypto. If you go all the way back to the Bitcoin white paper, this is 15 years ago now, the title of the Bitcoin white paper is Bitcoin, a peer-to-peer electronic cash system. And the vision of it was like cash. If I have cash in my wallet, no one can take that away from me. It's mine. I'm in control of it.
Unless someone steals it.
Unless someone physically steals it from your wallet, right? That's always a possibility. But if it's in your wallet, no one can take it. And these custodial products, people can take money away from you. If I rewind back to when I got into crypto, which was in 2012 or 2013, there was a big event in the global markets, which was that the Cyprus economy collapsed. And when the Cyprus economy collapsed, the government of Cyprus took a haircut off of everyone's bank accounts. They took money out of people's bank accounts. And that was possible because people were holding their money in this centralized institution called a bank. The government could just take their money away from them. But if those people had cash, that wasn't possible. You can't take it away. And so I think that these non-custodial products are so important because they allow people to have money like cash. It's like a physical wallet where you really own your money. There's no limits on it, no restrictions on it. You can do whatever you want with it versus these centralized products, which come with the downsides of participating in a centralized enterprise like FTX. There's always risk there.
So in a nutshell, what is your vision for the future of payments?
For me, the future of payments should be as much like cash as possible. People should be able to do whatever they want with their money and transact as seamlessly and easily as possible without restrictions or limits. There's so many things that are challenging. When you use peer-to-peer products today, there's a limit on how much you can send each week. People run into this all the time. You try and pay someone for rent on a peer-to-peer product and it says, oh, you can't send more than that this week. And why is that? It's because it's built on these antiquated rails. Peer-to-peer products are built on the ACH system, which takes days to settle a transaction. There's risk in doing so. And as a result of that, there are restrictions on your money. And I think it's crazy that there's restrictions like that I can only send my friends so much money a week. It's my money. I should be able to do whatever I want with it. And these non-custodial or self-custodial products enable that. Because like cash, you can do whatever you want to do with your money without anyone else having control over it. And the second thing is that it removes these trust assumptions. Again, when you use a centralized product, FTX is a perfect example, you are trusting that that centralized enterprise is not going to have issues, that they're not going to walk away with your money. And this has happened, unfortunately, over and over again over the past year. Whether it's FTX or Genesis or Celsius or BlockFi or Prime Trust, there's been a slew of them.
Unfortunately, yes.
Those have all been failures of centralized entities. Those have not been failures of decentralized self-custodial products. And if you do not want to trust these entities, if you want to be able to be in control of your own money, you need to be using self-custodial products.
On Wednesday, you tweeted that ECO is doubling down on crypto-native products and is sunsetting its US-only fintech app because custodial crypto products in the US face growing roadblocks. Can you elaborate on that?
Absolutely. So historically, we've operated two different products. We operated Beam, which is this non-custodial on-chain Venmo, this peer-to-peer payments product. We've operated the ECO app, which is a US-only consumer fintech product that can replace your bank with something better for saving and spending. And we've always wanted to integrate crypto features into the ECO app, this custodial product, and bring the ECO app and Beam closer together and kind of merge those two worlds. What we found is that there are enormous roadblocks in the United States right now, as of this year, offering custodial products that use crypto. And it's not just us, we've seen this all over the place. Revolut, a multi-decacorn neobank, stopped offering crypto services in the United States. And why did that happen? Because there's been a regulatory shift. And as a result of this regulatory shift in the United States, financial services or financial institutions like banks aren't willing to support crypto-related financial services anymore. They don't want to. It's a really high bar for them. There's huge regulatory uncertainty around it, so they don't want to support it. And if you're operating a custodial service, you need those partners. And what we found is that as much as we wanted to build the ECO app as this bridge to the mainstream and bring people on board to crypto slowly and steadily, eventually allowing them to move to a self-custodial future when they were ready, the US regulatory environment and partner environment just wasn't permitting that right now. So we've chosen to sunset that and focus all our energy on this Beam wallet, which is taking off. And we're realizing that today, the technology actually exists in a way it didn't 2 years ago to build self-custodial products that people can actually use. Again, I've been in crypto for a decade now. I have family members that have never been able to touch a self-custodial product because it's too confusing, overwhelming. There's all this technical stuff you need to deal with. But with this Beam wallet we launched, they used it for the first time. And they've sent money in a self-custodial way. They're holding money in a self-custodial way. And the new technology that's happened in the space has unlocked that. So we think we're coming to this golden age for on-chain payments, is what we call it, where self-custodial products and services and wallets can actually exist to be built in a way that's good enough for the mainstream.
Can you explain what the account abstraction in Ethereum, this Ethereum upgrade, what it is exactly for those who don't know and how it applies to payments?
Yeah, so account abstraction, I think, is one of the big unlocks that has enabled products like Beam to be built and be easy enough for mainstream users to use. So rather than building just for crypto native people that are really sophisticated about how crypto works, you can now build products for everyone. Account abstraction is a huge part of that. It is a very technical protocol upgrade or protocol improvement to the Ethereum blockchain, which is what a lot of these products run on. And the way I would think about it is that it's like the move from flip phones to smartphones. What I mean by that is that historically, before you had smartphones, there were flip phones or dumb phones, and all they could do was call and send texts, right? They could send messages, and that was it. You could call, text, and that was it. And then we got smartphones, and smartphones could run arbitrary code. All of a sudden, you had this ecosystem of applications that could do all sorts of things. It wasn't just calling and texting anymore. Now you could do pretty much anything on your smartphone. And the parallel is that in the Ethereum ecosystem, historically, user accounts have been what are called EOAs, externally owned accounts. And what that means is that all they can do is send and sign transactions. It's like calling and texting. That's all they could do was send money. But now this account abstraction technology allows user accounts to run code, just like a smartphone, which enables all sorts of new things to be built that couldn't be built before. So before, all you could do was send funds from your Ethereum account. Now you can run code and actually do interesting things. So that's the parallel flip phone smartphones, but why does it actually matter? I'll give you an example. Historically, when you send anything on Ethereum, you need to have Ethereum tokens, Ether tokens, in your wallet to pay for the gas fees, to pay for the transaction processing fees. So even if you're sending something like a stablecoin, like USDC, which is pegged to the dollar, you still need to have Ether in your wallet to pay for the gas fees. And that's kind of crazy when you think about it. It's a little bit like saying to someone, to send me US dollars, you need to also have Venezuelan bolivars in your wallet to fund this US dollar transaction fee. It doesn't make any sense. But now with account abstraction, wallets can run code, and part of that code can be saying, hey, I'm actually going to ask someone else to pay the Ethereum gas for this transaction, and I'm going to pay them a fee in the thing that I'm sending. So if I want to send you USDC, which is the dollar stablecoin, instead of needing Ethereum in my wallet, Ether in my wallet to fund the transaction fee, I can send it with just USDC as the thing to pay the transaction fee. And this is much easier. Historically, to onboard someone to a crypto wallet, you need to give them this Ether token or whatever the native token of that blockchain is. Now, you can just give them whatever token they want to send, and that makes it a much easier experience for them. There's a million other things that account abstraction enables, but at a really high level, it unblocks the ability to do much more sophisticated things with user wallets and make it much simpler for people.
Turning to recent developments in crypto, payments giant PayPal just launched its own dollar-backed stablecoin that happened last month, and now it's available on Venmo. What do you make of that development? The fact that PayPal is moving deeper into crypto, what does that signal to you?
It's great news. I mean, it's a big signal of institutional adoption. We're really happy they're entering the space. I think one of the biggest roadblocks for on-chain crypto payments right now is the on-ramps and off-ramps. So how do you get money from the existing financial system onto crypto rails and then back off? And that's a critical part of enabling payments on-chain. If people can't get their money onto the blockchain, how are they going to be able to send money on the blockchain? And PayPal is unlocking this in a really big way. They've created their own stablecoin, and they're making it really easy. I've done it on the PayPal website. Really easy to buy that stablecoin from your bank account. I have my bank account linked to my PayPal account. I went in, I said, I want 20 PayPal USD stablecoin. Said fund from my bank account, press the button, and I had 20 PayPal USD stablecoin in my PayPal wallet. And that's an amazing experience. It goes the other direction too. They've enabled off-ramping, so you can move from that to your bank account as well. And that's a necessary thing for on-chain payments to happen. Without that, people just won't have money on the blockchain. They can't make the payments on-chain.
So we have seen some regulatory advancements here in the U.S. as it pertains to crypto. In fact, in July, the House Financial Services Committee advanced a bill to establish a framework for stablecoins. What do you make of that development? Do you think it's actually going to get approved? And obviously, this has been long awaited, this stablecoin bill. So what do you think this move signifies?
It's really hard to say. For years now, we've seen Congress in various ways putting forth different bills to try to establish a more clear regulatory regime for crypto. And I think what you'll see if you look around the industry is that major participants want clarity. They're open to regulation in many ways, but they just need answers as to what it is. And right now, a lot of the industry is operating in this kind of nebulous, unclear space where different regulatory agencies are claiming jurisdiction over different parts of the ecosystem. And it's hard to tell what the base truth is. We're seeing a lot of regulation by enforcement rather than actual rulemaking and lawmaking. And so I think the stablecoin bill and others are good in that they're an effort to give clarity. Do I think that one's going to pass? It's unclear if that one will or not at this point, but it has to happen at some point in the next few years for the industry to advance. Otherwise, without clarity, players will not be able to do what they need to do. And this ties back to what we were talking about earlier, that these banking institutions in the United States, because of the lack of clarity from the US government about the regulation of crypto, they just can't support crypto innovation in the way that they want to. And so even those banks and banking institutions, they're asking for the same clarity, so that they can know who they can help, who they can serve, and who they can partner with, and that's just not there quite yet.
So while we have been seeing these regulatory advancements here in the US, the advancements abroad have been happening quicker and sooner than here in the US. In fact, in April, EU lawmakers approved the world's first comprehensive framework for crypto regulation. We saw more advancements in places like Hong Kong, the UK, and meantime, we're seeing crypto firms here in the US, including publicly traded companies like Bakkt and Coinbase, outline their international expansion plans. A lot of these companies are moving overseas amid the lack of regulatory clarity here and the regulatory advancements abroad. What do you make of the push from crypto companies here in the US to expand overseas amid this backdrop?
I think it's something they simply have to do at a certain level if they can't get clarity from the US government. If they want to serve a global audience and the US government won't give sufficient clarity as to where the lines are and what's possible, then going to a jurisdiction where it's much more clear, I think is really the only feasible thing for them to do. And I think it's important that these companies are signaling that they're willing to go to that length. Those companies that you mentioned, they would rather stay in the US. They would rather be here and fully support the US economy and be a part of the ecosystem. But without clarity, they can't do it. And so it's an important signal to the government for them to be saying, we're willing to leave and go and build up operations more elsewhere if you cannot give us clarity. And I think that's an important messaging point because it adds pressure and adds urgency to the idea that this sort of regulation must be clarified.
In a nutshell, what do you think is preventing mass adoption of crypto? Is it the lack of regulatory clarity here in the US?
I don't think that's the core thing. I think products like Beam, which are non-custodial or self-custodial, actually make it much simpler from a regulatory perspective. And so that, to me, is the best possible path. And the reason those make it simpler is because non-custodial or self-custodial products, they have fewer middlemen that need to be regulated. There aren't middlemen that you're trusting with your money. And that's ultimately where regulation really matters. The reason firms need to be regulated is because they're holding user funds. And regulation is the way to make sure that they're doing so appropriately. But non-custodial wallets, there's no one holding user funds. There's no custodial entity, and so that removes the need for a lot of the regulatory burden because users are fully empowered, they're in control of their own funds. And so I believe that the answer to mass adoption globally will be in non-custodial or self-custodial products because it allows for products to be instantly global. There's this lack of middlemen, the lack of burden there, or the reduced burden there. And so I think that's the answer. But then the question becomes, well, why haven't those become massively adopted globally? Why hasn't that really happened? And I think ultimately good enough products just haven't been built. I don't think they were really possible until this year with the rise of account abstraction, roll-ups, and other ways to make transactions cheaper and faster and easier. I think it is now possible to build those products. Now it's just a matter of people doing it, sitting down and thinking about the consumer, finding use cases, building products, and growing them. And that's what will lead to mass adoption. So to sum it up, I think all the tools are there right now. And now it's just a matter of people actually building products, getting into that go-to-market motion and bringing it to the world. And that's what I'm really excited about for over the next year.
So what's in store for the future of Beam and Eco? What are you focused on right now?
Yeah, so Beam is growing really quickly. We launched it a couple months ago. It's over 80,000 users now. People are using it and are really excited about it as an easy self-custodial product. We've seen the most adoption in Indonesia, Vietnam, Nigeria, and then the US and India. So a really varied slate of places around the world. And we're just doubling down on all of that, supporting more assets, making the flows even easier for people, adding functionality that makes payments even better, building out things like merchant adoption and allowing people to pay more easily at merchants with the Beam wallet, and then just growing it. And so we're really focused on that. And separately, we work to support this broader thing called the Eco protocol. And the Eco protocol is an attempt to build, we call it an alternative to stablecoins. Something that's actually unpegged from any existing currency, but is usable as money. And I think there's been this dichotomy in crypto so far. Assets in crypto have either been independent from existing currencies, but not really usable for transactions. So Bitcoin's an example of that. Ethereum's an example of that. Totally independent assets, not tied to any nation or any individual currency, but not really useful for transactional usage. They're too volatile. Or we've had stablecoins. And stablecoins are incredibly useful for transactions. There's massive adoption for stablecoin payments globally, but they're not independent. They're tied and pegged to existing currencies. And I think there's an opportunity for a middle ground where you could support an asset that is both independent, not pegged to an existing currency, has its own monetary policy, but also useful, is sufficiently low volatility to be used for payments. And so when we think about building Beam's adoption, we're also thinking about how can we support the adoption of Eco as a currency, as an alternative to stablecoins.
Interesting. Andy Bromberg, CEO of Beam and contributor to the Eco Protocol. Thank you very much for joining us here in New York City.
Thanks. It was great to talk to you.